The recovery of the Chinese economy has stirred hope globally, as has the sharp recovery in the US indices, notably the Nasdaq. Chinese industrial output in April rose 4% after contracting nearly 14% in the first 3 months of the calendar year. Chinese fuel imports, we are told, is now back to pre-COVID levels. Since China was the first to be affected by COVID-19, the world is wondering if we should take heart from the Chinese recovery. Back in the US, unemployment numbers are approaching 40 million. The Nasdaq is nevertheless within 5% of its February highs. So are markets telling us that we are on the road to recovery? What will be the global speed of recovery and the different speeds of recovery of the different regions? In our special series, Global Dialogues, I have with me 3 economists of global repute. I have with me Chetan Ahya, Chief Economist and Global Head of Economics at Morgan Stanley, Chetan Harris, Global Head of Economics at Bank of America Merrill Lynch, and Jahangir Aziz, the Head Emerging Market Economics at JP Morgan. Gentlemen, thank you very much for joining me in this very special and much to look forward to chat. Let me start with you, Chetan. Exactly this. What are you taking from the Chinese, so to speak, recovery? Is it giving you a sense that global recovery will follow suit pretty quickly?
Yeah, sure, Lata. I think the key thing that we were highlighting is that, the speed at which the China businesses are able to restart is some indication of how things could go in other parts of the world. Of course, there are a lot of differences between the way China operates and the scope of the outbreak in the US and Europe. But we definitely thought that that was one indication that was giving us that the manufacturing businesses will start much earlier in every part of the world. And look, over the last few weeks, what we are also seeing is that the services sector in China has also been able to restart. One factor that I have been watching is the traffic in the subways, because that's where you really have a large congregation of people. And that has also recovered to around 80% in China. So I think this development is definitely heartening in terms of assessing the progress in other parts of the world.
Okay, Chetan Harris, would you agree? Have you lately, increased the speed of global GDP recovery or of any of its specific regions?
Well, I think that China is a best case scenario, because let's remember that China was able to drive the number of new cases down to 0, and they're only experiencing very narrow hotspots right now. They have an extremely aggressive tracking and quarantining system. Of course, it's a very heavily government-controlled country, so they can do draconian shutdowns at the snap of a finger. The difference between China and the rest of the world is none of the other countries have been able to get cases down to 0, except the ones like China that have serious tracking and tracing programs. So when you think about the re-engagement you're going to get in the US and Europe, it's going to be quite slow and hesitant, because it's not just about governments announcing, oh, you can go out and have fun now. It's about individuals feeling trust that if they do enter that subway or they do enter that crowded area, that there's nobody in that crowd that has the virus. And so I think we've already seen some evidence in the US with the initial opening up in some states, where we look at the data, high frequency data like credit card spending, the pickup in activity is very slow. And for good reason, because people are very cautious. So yeah, it's hopeful, and it shows that you can come out of this. But the experience in China is really a best case scenario.
Fair point. Just coming back to you on the trade issues as well, and whether that could be disruptive. But your take, Jahangir Aziz, do you see different speeds in the East itself? Maybe China has been able to recover, but will many of the countries do as well as China? What's your pecking order?
No, I mean, there will be a difference of speed. And I think if you look at the Chinese recovery, we called it a sight to behold. And I think it is a sight to behold. Industrial production in level terms is almost back to where it was in December. Production of cement, production of steel are all back there. As Chetan talked about, service sector, so consumption and retail sales will be lagging, but there too we've seen a significant upturn that has always taken place. Just about 10 days back, when we were discussing about China, we would say that the very sharp recovery that we had in the second quarter, maybe there is downside risks to it, because of the high frequency data wasn't showing that. But I think as the data flow has come in, I think probably there's an even upside risk to what will happen in China in the second quarter. That is not the case in the rest of Asia, even in countries that are very closely tied to China, Taiwan and Korea. Forget about the rest of the countries. I think in the case of Korea, Korea is much more open to what happens to global demand, because its entire export base is not just China, but it's also based on other countries, and it is getting hit. In the case of Taiwan, Taiwan is actually doing better than what we had expected, but almost entirely on IT. And IT has clearly been the one place where global demand has actually picked up because of work to home, etc., etc. However, there, I know you want to talk about political risks there. I think over there is a political risk. I think the ruling that was done 10 days back, which affects Huawei, actually affects also TMSC, which is what is the largest semiconductor producer in Taiwan, because one of the biggest customers is Huawei. So yes, I mean, we are expecting different speeds taking place, but I think a lot will depend upon policies, the pace of opening up, what kind of policies are going to be put as part of the support from the governments. So I think these are all things on which the ultimate pace at which begin with, and as Ethan said, it will also depend upon how human behavior changes.
And we do not know. Yeah, I agree. And I think we are all proceeding on the assumption that there will not be another big wave. And if that were to happen, perhaps bets are off. But I want to get the other factor in, and which you alluded to, Jahangir. Chetan, how worried would you be that global trade could get disrupted primarily because of the tensions that existed anyway, even before? It seemed to be ebbing, the US-China trade tension. But now we're seeing President Trump attack both the WHO and China for the virus itself. So do you think there could be a serious disruption because of people wanting to kind of at least pull out of China or diversify from China? Chetan. Chetan, can you hear me? Okay.
Yeah, sorry. In terms of the actual trade data, Lata, we are getting the exact opposite. Today we got the Japan trade data, and what it was showing is that the China imports for Japan had picked up. And so right now, because China is still pretty much entrenched in the supply chain, at the margin, the data is showing that China is doing better compared to other countries in trade. But yeah, in the medium term, that is the risk. Our view at this point of time is that the U.S. administration will be watchful of the economic impact of any additional actions in front or on tariff front. And so they will focus on non-tariff measures rather than taking up additional tariff on imports from China. Okay. And the reaction of the economies will be based on what type of response the administration takes up. If it is non-tariff barriers, then I think in the near term we have less risk to the global outlook. But if it is tariff actions, then that's the one which we have to consider. But right now we are operating with the base case assumption that it will be non-tariff barriers.
Okay. What about you, Ethan? Are you expecting that companies will aggressively want to diversify out of China, and nations will also encourage that? I mean, we did get that out of Japan, isn't it? Giving SOPs for people who move out of China.
Well, we need to be careful here about the way we interpret recent statistics. I mean, when you come out of a shutdown, you're going to have shortages of some things, and so there's some pent-up demand that increases activity for a while, and that may be explaining some of what's going on. with China. So we need a few months to figure out what the real demand situation is there. I think that I'm actually more worried, to tell you the truth, about non-tariff barriers than tariff barriers. The biggest risk here is the tech war. It's the idea that the U.S. would decide to cut off Chinese companies from critical technology. And when you do a cutoff as opposed to a tariff, there's no way around it. It's not like you can pay the tariff and continue to operate your business. And I think it's very likely that we'll get a major response from China if the Trump administration follows through on a lot of the threats they're doing. With that said, I don't think they are going to move ahead aggressively. I think this is a lot more rhetoric than reality. There's a good reason why the Trump administration agreed to a phase 1 trade deal at the beginning of this year. It's because it's an election year. Any major escalation that starts to damage the equity market and then subsequently the economy threatens President Trump's reelection. So I think the trade war is more of an issue for after the election, or if China decides around the election that it's time for them to hit back, it could happen right around the election. But right now, it's a lot more rhetoric than reality. And the final thing I would say is that while there's a lot of talk about moving supply chains out of China, you don't do that during a recession. During a recession, you have spare capacity all over the place. You're not going to invest billions of dollars in new factories in the middle of a recession. So the recession is going to slow down the reshoring and the movement of business, even as the Trump administration puts pressure on companies to get moving. They're all going to try to delay and think about this in terms of plans. But to actually do a big investment movement during a recession, I don't see how that can happen.
All right. Actually, that is one worry less if that's how companies and countries are going to behave. But Jahangir, I thought there were, emerging market economists were actually saying that there will be winners and losers from this COVID battle, and some countries like Vietnam and Indonesia are doing very well. No, you don't think so? That there are winners emerging from this, and is India anywhere in that pecking order?
You mean the
shift out of China? Yes.
Yeah. So again, I'm going to agree with Ethan. First of all, in a recession, you don't do something like that. I mean, governments will want you to do it, but you never do something like that in a recession. But even after a recession, I think the way in which we were thinking about it, countries would shift out of China to some other parts to diversify risk. The question is, what is the risk that that these companies are diversifying? The risk that they're diversifying is that U.S. does not go after these countries on intellectual property, on transfer of technology, on subsidies that these countries provide to their own companies, et cetera, et cetera, et cetera. No one was talking about companies shifting out of China because there are better cost structures somewhere or better, easier way of doing business. That had always been the case, and countries had decided to relocate in China and one moved out. But if the reason as to why people are moving out is because there is a concern that you could get a decoupling between U.S. and China because of China's intellectual property, transfer technology, etc., then the discussion needs to be which country offers that. Okay. The discussion can't be that India is going to be the place where China is going to move because labor costs are lower or easier to do business. It has to be, does India have better intellectual property right than China does? And that is not where the discussion is taking place. So I'm not exactly sure how those two arguments work because so far we have seen absolutely no evidence of any company actually shifting out of China. They're talking about it.
Oh, right. All right. So that removes one big political battle, perhaps in India, that this could be a factor to attract business. But, although all three of you are specialists in global economics or specific regions, at least two of you will have an emotional view on India. And an intellectual view as well. So I am going to get to that view. Chetan, now, what's your sense? When we sit inside India, we get the feeling that we have gone into the crisis weaker than other countries. and our lockdown is more severe than others. That's how we understand it. Do you think India is going to be a shell of its former self, as a former RBI governor put it recently, because even this fiscal stimulus has not been that much? Chetan.
Yeah, I think, Lata, emerging markets and India, I think, are in the same place this time. And I think the difference in this cycle versus 2008 is that emerging markets do not have the policy buffers that they had during 2008 crisis. So we think in this cycle, they are more likely to beta play rather than being able to generate domestic demand alpha through counter-cyclical policy support. And look, I mean, within EM space, there's a lot of disparity. So Asia and India are better placed than, Central Emerging Market Europe and Latin America. But yet, I don't think that this cycle, emerging markets like India will be able to provide a domestic demand alpha. So they just have to, unfortunately, take the pain and hope that recovery comes through in the global economy, and that's what will bring back these emerging markets.
Okay. Your thoughts, Ethan? I don't know whether you look specifically at India, but is it in a bigger hole than it was?
Well, I mean, India is going to be pulled down with everyone else here. And as you said, the lockdown's been pretty severe there. India was already weakening before the shock hit. So we're looking at an economy that was growing at 7% or in that range. It's going to be 0 or negative. And is shell of its former self? Well, a lot of economies are going to look like a shell of their former self in the next year. So I think the real question is, does India do a bit worse than other EM, or is it really in the same basket? But, this is an indiscriminate shock. I mean, you can't run away from this. I mean, we talked earlier about trade. Even if you somehow manage to contain the virus within your own country and you have strong monetary and fiscal stimulus, you're still going to get pulled down by global trade. So, India is going to be it's going to be grim in the next year, but I don't think it stands out relative to other countries.
For you, Jahangir Aziz, does it stand as a slight outlier or maybe lower in the pecking order in terms of the ability to come out?
No, I mean, I think, as both Ethan and Chetan said, I think I look at the world, emerging market world, in terms of the frontier countries and middle-income countries broken up into the low yielders and the current account surplus, and the high yielders and the current account deficit countries, India, Brazil's, Mexico's, South Africa's of the world. And if you look at these countries, which also happen to be the largest emerging market countries except for if you leave aside China, I think there is an existential question, actually, much more than whether or not they will come out of this crisis. I mean, if you just look at the kind of revenue shortfalls that these countries are going to have, this is going to be absolutely astounding. So we are looking at fiscal deficits in the case of South Africa, 14.5%. In the case of Brazil, 15%. In the case of India, the public sector borrowing could be as large as 13.5%, 14%. They have to figure out, and all of this, by the way, Lata, is not based on any stimulus. Yeah. It is based on just pure revenue shortfalls, and whatever COVID-related support you're giving has to be offset by cuts elsewhere. So I think before even we go to how it might look over the medium term, I think they have to actually get through this existential period. If they don't, then the next 12 or 18 months, the period that will be required for the economy to recover, can itself get pushed back because the government does not provide sufficient amount of support, or the government policies become a headwind.
Okay, so there is some good reason why we are beating ourselves with worry. Chetan, I found one of your reports most interesting. You're seeing the return of inflation to the global economy in a couple of quarters?
Couple of years,
Yes,
but
okay.
yeah,
that's a relief.
We are basically, it was a medium-term call, basically trying to say that, look, whatever we are seeing right now, when I put my understanding of what's been going on in the global economy in different pockets, it just makes us feel that this cycle is different. So when we come back, you will see somewhat higher inflation than what we have seen in the previous two cycles. So three things that make us think about this. First is that compared to consensus and the markets, we think that the U.S. and the global economy comes back faster than GFC. Second is that we are seeing coordinated fiscal and monetary policy easing in an unprecedented manner in developed world. So, for example, Jahangir was just mentioning about the emerging market deficits. In the U.S., the fiscal deficit this year will be in the range of around 24% of GDP, assuming that the additional $1 trillion fiscal stimulus comes through. And you are seeing the Fed announcing a large QE program. We expect the Fed to do quantitative easing or balance sheet expansion by 38% of GDP. That will be compared to 20% of GDP with QE 1, 2, and 3 taken together. So coordinated, timely, large-scale fiscal and monetary easing is the second factor. And the third is, as you were asking about the trade tensions between U.S. and China, and it has been our view that one of the reasons we had this structural disinflationary trend in the last 30 years was because of the trio, which we call triple T, trade, tech, and titans, operating together, driving structural disinflationary forces. And now we are seeing intervention in that. And the reason for that is because inequality is rising globally, particularly in developed world, and politicians are getting forced actions to disturb this trend. So that's why we are highlighting that, look, don't underestimate the inflation risk. Right now, if you look at the fixed income markets, they're totally underpricing the inflation risk. And that's where we were thinking that we should highlight this out of consensus.
All right, but it's 2 years down the line. If we had an added problem like that for the Indian menu, it would have been even worse. I just have to ask you one more question on India, Chetan. But before that, Ethan, is there anything that you are looking at in the global sphere and saying that these governments are getting it right, and something that you can, the Indian government can copy? Anything that comes to the mind?
Well, let me just say a word about the inflation picture, because I think we have a bit of a disagreement. I agree in 2 years out, there's, inflation could be up or down because things are going to change a lot. If we have a massive pulling back in free trade, the initial impact of that is deflationary. It crushes demand as people lose confidence, but eventually it could become inflationary as you cripple the productivity of traded goods sectors. But I think that this idea that the fiscal and monetary stimulus is inflationary is wrong. I mean, fiscal and monetary policy are filling massive holes in the markets and the economy right now. We're still going to have unemployment across the world well above average, well into next year. And so, QE only matters if it causes a lending and spending boom. And I think QE is basically just stopping a collapse in the financial markets. So I think the market's right. This is disinflationary in the short run, and in the medium term, it could go either way. On the lessons learned, listen, every epidemiologist and I think most economists would argue the most important thing here is to be smart about the way you do your health policy, and that means testing and tracking is incredibly important. That is key to creating confidence in the economy where people feel okay about going out. It's important to do significant fiscal offset, but for emerging markets, we're going to have a real challenge. How much can they get away with here? It's a lot easier for the U.S. and Europe to borrow than it is for emerging markets. And then finally, governments need to be smart about what they shut down and what they don't. Focus on the things, we know that there's super spreader events and people. Focus on that. Don't reopen bars. Don't reopen restaurants with big crowds. Don't reopen sports events. But do reopen public transportation, because it's absolutely vital to your economy. You can't run an urban economy without public transportation. But do it in a smart way where you get as many people as possible working from home so the system is less crowded.
Yes.
That's a risk worth taking.
Yeah.
But opening crowded events that have small economic impacts is a bad idea. So it's about kind of taking the smartest approaches, not following what political pressure is telling you to do.
Yeah.
I think that's the lesson to every economy.
Well, we have slowly started public transportation in terms of air and rail. Let's hope we are smart about it. Chetan, one point that has disappointed you about policy and one word of advice. With India in mind.
Well, I think the disappointment is more really in terms of the magnitude of policy response. It came in a little late. I think it should have come in much earlier. And there is probably still scope to do some targeted fiscal easing in India. And I think that's the one which is somewhat disappointing. And then the positive thing is, Lata, I think the health response that India took in terms of, taking up lockdown across the country at one shot, when we see other emerging markets, like, for example, if you think of Brazil, that response has been lacking. And so compared to Brazil and some of the other emerging markets, I think India's health response was pretty good, because ultimately, you have to attack the beast. The bigger problem is COVID-19. And so if you address that, then you are going to be able to recover faster. Okay,
so a word of praise for that. Jahangir, any one point of advice for the Indian government? Ethan said that, India, emerging markets can't borrow or spend as much as developed markets can. But do you think at this point in time, taking a bit of fiscal risks is in order? You don't really have to worry too much about rating agencies.
Look, we wrote a big report on quantitative easing in emerging markets, and particularly highlighting the fact that both the high yielders and the low yielders will be forced to do quantitative easing. We've already seen that happen. And I think that India will have to be part of that. You really cannot ask the private sector to fund, 1.5 times more than what they had funded the previous year, which is 2019. And there has to be central bank funding, and there has to be forward guidance on that. I think forward guidance will become very important. Without that, you have a very high probability that because the countries cannot provide the adequate fiscal support, the recovery actually gets stymied, and that really hurts the medium term.
Okay, that's a fund of advice from all of you, and analysis and forecast. Thank you very much, Chetan Ahya, Ethan Harris and Jahangir Aziz, for joining us in our special edition of Global Dialogues.